Hello learners, hi, how are you? I hope you all seen the first part of liquidation of companies video by now. If not, please do go check out part 1 on liquidation of companies on this very YouTube channel. And now I'm going to bring you detailed discussion of liquidation of companies a little ahead from where we left in the last session. So if you remember, in the last session, we were discussing as to what sort of questions come from the chapter of liquidation of companies. That is questions on preparation of statement of affairs. There can be questions on preparation of liquidator's final statement of account and also questions on computation of B-list contributors. In the last video, we've done discussion on how to prepare statement of affairs theoretically. In today's session, we'll see the format of preparation of statement of affairs and we'll also see one problem from our ICA material. And after that, we will be starting with liquidator's final statement of account. So let's go ahead. And before I go ahead and show you the format of liquidation of companies may statement of affairs, I have an announcement to make for all of you people. This is with regard to Excel with Yash's Group 1 batch for May 2023 examination. So this batch has just started on an academy platform. It is from the team of Yash's Academy. We'll have Mayur sir, Ravikant sir and me, all three of us together handling the Group 1 accounting, and Vijay sir handling law and tax, and Dhananjay Bhavi sir handling cost and management accounting to you people. So what are you waiting for? Enroll for this batch. You get live interactive classes and recorded backup of the class will be available to you all. And you also have quite a lot of other features if you take up iconic subscription, like printed material arriving at your doorstep, doubt solving sessions at regular intervals, and one-to-one live mentorship. So whenever you go for enrollment, please do use the code YESHAS, which is YESHAS, to avail 10% discount on your subscription fee. And the tentative schedule for the months of July, August, September is available here. My classes for my part of accounting syllabus will happen a little later in October, November types. So till then you will have classes from Mayur sir, Vijay sir, Ravikant sir and Dhananjay Bhavi sir. So that's the news about the batch that we're starting. Let's get back to the topic of liquidation. So far we've discussed about how to prepare statement of affairs. We discussed all of this yesterday, last video, lists and all. So we've discussed as to what list may what item will come. Now we'll discuss in detail as to how the presentation needs to be made in this regard. Yeah, so we spoke about deficiency or surplus computation in the last one. I told you it is usually, though it is a statement, is prepared under double entry system. So we go on writing a book value of the assets and the realizable value of the assets. If there is difference there, that would lead to realization deficiency. If in case the asset is sold at a price higher than its book value, it would lead to surplus. So we go on writing the surplus or deficiency arising from sale of assets, and ultimately we'll check the amount available and amount payable. Both the differences should match. Whatever deficiency or surplus arises in list G when you go to make payments to equity shareholders, and the computation that we've done simultaneously in list H, both should match. I'll show it to you with the help of a problem. So here we go. Let's quickly see the format. The format of statement of affairs goes like this. We need to start with the name of the company. We'll write in the matter of whatever the name of the company is, which is going to liquidation. And it is a statement as on a specific date. Yeah, so you need to write statement of affairs as on what date are you preparing this statement. And then we'll have two columns. One, the book value column for amount. This is for the purpose of disclosure basically. And this is the estimated realizable value. What is the money that we are expecting to receive on sale of that asset? The difference between this book value and estimated realizable value will lead to surplus or deficiency. Yeah, let me write that. Surplus I'll write in green. Rest of it I'll write in black. Arises because of difference between book value and estimated realizable value. So between this book value and estimated realizable value, whenever there is difference, that would go on to our list H. You get that? Yeah, as I mentioned before, we'll do a problem on the same. We'll start with list A. We know that list A and list B talks about assets. List A talks about assets not specifically pledged. List B talks about assets specifically pledged. So unless they specifically mention that an asset is under charge or asset is under encumbrance, all the assets are assets not specifically pledged. So under list A, we go on writing all the assets which are not specifically pledged. Yeah, we'll write the list of them. Against them, we'll write their book values. We'll also write their estimated realizable values. Difference between these two will go to list H. Then we'll go to write our list B. List B will have assets specifically pledged. Whenever we write assets specifically pledged, we'll write their book value and we'll write their estimated residual value. But this estimated residual value will not come in the outer column. The estimated residual value will come in the inner column because this money that is received from the sale of assets specifically pledged cannot be straight away used to pay any other liability or shareholders. This has to be first adjusted against our secured creditors. We pay off our secured creditors. After paying off the secured creditors, if there is any money remaining, only such money will be called as surplus, and that surplus would appear in the outer column, and this surplus will be utilized in payment of other liabilities, meaning liabilities other than secured creditors or shareholders. If in case this secured creditor exceeds this asset specifically pledged, then the part of secured creditors which cannot be repaid by way of this will be usually used for what? Yeah, will be usually used to be paid. I mean, say it will not be used, it will be repaid along with our other unsecured creditors. I hope you guys got this point. Did that make sense, guys? I hope it did. Chalo, let's go to the next part. Fantastic. So after that, what do we have? List C. In list C, we go on to pay preferential creditors. Now from now is only payment, no realization. List C is preferential creditors. List D is debenture holders. E is unsecured. F is preferential, and then G is our usual equity holders. So before we start paying all other liabilities and shareholders, we'll just summarize as to how much cash is available. The cash available with us is realization from assets not specifically pledged and surplus from assets specifically pledged left over with us after paying secured creditors. So that's what we'll make a list here. So summary will have ANSP, assets not specifically pledged, plus surplus from ASP. So this, my friends, is the amount available which can be utilized to pay the liabilities. Now in the liabilities payment, we'll start with our preferential creditors. The first liability that we'll pay will be preferential creditors. Preferential creditors, as I had told you people in the previous video, will include government for tax dues within last 12 months or any other dues, and then laborers and employees to the extent money is due for the period of 4 months in the last 12 months, it will be preferential creditors. Beyond that, it will be unsecured creditors again. Or if there is any wages, I want to say not wages, what do you say? PF due, ESI money due, gratuity money due, retirement money due, any of these money due, leave travel compensation, all of this will be preferential creditors. So all of this will write. You might not pay them to the fullest. So to the extent we'll write their book value and we'll write the payment. If they both are matching, no surplus, no deficiency. If the amount payable, that is book value is more and amount paid is less, then such difference will lead to surplus. However, if the amount payable is less and amount paid is more, that will lead to deficiency and it will get posted to listage. So throughout when we are preparing statement of affairs, remember to post the difference between book value and estimated residual value as a positive or a negative item to listage. Then after we done with list C, then we'll go to list D. List D is our debenture holders. What is list D? Debenture holders. So when you go to list D, debenture holders, we'll pay off the debenture holders their nominal value of debentures. If there is any premium on redemption, we'll pay such premium on redemption. And if there is any outstanding interest, such outstanding interest, all three of them together will be paid to debenture holders. If outstanding interest is already provided for or premium on redemption is already provided for, then our book value and estimated residual value will match. I'm going to say the payment. If the book value is less, meaning you are not provided for debenture redemption premium or you are not provided for interest outstanding, but you ended up paying it here, then you're paying more than what the liability actually is there at book value. That would lead to deficiency. Or in a vice versa scenario, there is outstanding interest, but it is been waived off and you don't have to pay. In such case, the amount outstanding is more, amount paid is less. In such case, that would lead to surplus and it would go to listage. I hope you guys got this. That's with our list D debenture holders. After we pay off our list D debenture holders, any money remaining will be used to pay list E. List E will be unsecured creditors. Unsecured creditors will not just include such creditors without any guarantee. It will also include such creditors who had guarantee, who had security, but the security they had is not sufficient to pay off their liability. Meaning, unsecured creditors will include secured creditors to the extent unsecured. Meaning, secured creditors to the extent asset realized cannot fulfill their security. They will come. And preferential creditors or government tax dues, amount payable to employees and laborers beyond the preferential credit limit. All of that will come in our list E. Oh, here again we'll write the book value as well as the estimated money that we should pay. If they're matching, all good. If you pay more, that will lead to deficiency. If you pay less, that will lead to surplus. I hope you guys are getting this. Next, we'll go to list F. In our list F is preference shareholders. Again, to preference shareholders, you will pay the nominal value of preference shares. If there is any premium promised on redemption, such premium should again be provided for. And lastly, we'll also write the preference dividend. So, to our preference shareholders, you would pay nominal value, premium on redemption of preference shares, as well as preference dividend. All of this together needs to be paid to preference shareholders. If in case such premium and such preference dividend is already provided for and then returned to on the liability side, then the amount paid and the amount payable matches, there is no surplus or deficiency. If we pay more than the book value, what's there in the liability side, that will lead to deficiency. If we pay less, that will lead to surplus. So I hope you all understood how to prepare list F and then what sort of payment is to be done and how will it affect the deficiency or surplus. Once we're done with list F, we'll now then move on to list G. List G will have equity shareholders. So what is the amount payable to equity shareholders? Here we don't compute premium to equity shareholders or what is say dividend to equity shareholders to the extent accrued. No, all of those won't come. We'll see the amount available. This is after paying everything else. What is the amount available? No, sorry, amount payable. This is amount payable. What needs to be paid, and over here what we have is amount available. After paying all other liabilities, this is the amount available. So let's compare amount available and amount payable. If we have equal money, so all good. Like I explained yesterday, it is what to say impossible, but a scenario which is on cards. So if that is there, then all good. If in case you have more money, that will become surplus. If you have less money, that will become deficiency. Surplus or deficiency is found as difference between these two items, and whenever we find this surplus or deficiency as difference between these two items, the same should match according to the computation that we done in list H. List H may we start with accumulated losses. So you might not be aware of the fact as like why is it that we start with P&L debit balance or accumulated losses. The answer is very simple. P&L account debit balance or accumulated losses is like an asset. It's not an asset. It's a debit balance, no? So it's like an asset. But can I write it in ANSP in list A? Not possible. Why? Who will sell losses? Who will buy losses? So it has book value. It doesn't have estimated realizable value. Assume that I'm writing here. I'll write here losses. Book value 1 lakh. Estimated realizable value 0. So 1 lakh worth of an asset is sold for 0 rupees or realized as 0 rupees. Entire 1 lakh will lead to deficiency. That is the reason we straight away take such amount of losses in listage. And loss on sale of assets, that is assets sold below book value, minus profit on sale of assets, that is assets sold above book value. Because we're starting with deficiency, losses will add on to deficiency. So all the items adding on to deficiency will add loss on sale of asset, excess paid to liability. Items decreasing deficiency like profit on sale of asset or profit on repayment of liability. All this will go on decreasing it, and that's how we'll finally arrive at my deficiency or surplus. I hope you all understood this part, and I don't usually recommend you people to mug up the format of listage. Listage people you mug up the order, so you don't have to. Just remember the logic: what leads to increase in deficiency, what leads to decrease in deficiency, and that's how we prepare statement of affairs. So without wasting much time, let's quickly get into our ICA material. Solve a question, pick a question from the ICA material and then solve that. Once we're done with such one question, then we'll go on to liquidator's final statement of account. All good, guys? Chalo, let me quickly open one question from our ICA material. You go to students, BOS knowledge portal. There's a new website now available. I mean, say the entire website is revamped. You go to study material, intermediate, advanced accounting, study material for advanced accounting. You'll open the chapter of liquidation in module 2. So there we go. This is our material, liquidation of companies. Let us now pick a question on statement of affairs. There's some power disruption, power coming in and going out. So the light is varying a little. I hope it doesn't affect much. Wait, let me see. I already have the question ready. Illustration number 12. These are all on different topics. So we're slowly moving on to the topic of statement of affairs only. There we go. Illustration number 12 is here. Yeah. So X Limited went into voluntary liquidation. What do they want us to do? Prepare a statement of affairs to be submitted to the meeting of members and creditors. Only after this meeting of members and creditors and board meeting and approval, what will happen? Our liquidators final statement of account will start happening. So that's the reason I was telling you the guys that you should read this part first. So chalo, let us start with illustration number 12. You guys can start seeing this question from your ICM material also, your copy of ICM material. This is from page 7.32. X Limited went into voluntary liquidation on 1st of April 2011. The following balances are extracted from its books on that date. Let's start. Firstly, machinery, leasehold property, stock, debtors, investment, cash in hand. All of these are assets. All of these are assets. P&L account debit balance will straight away go to our list H because this asset cannot be sold. Then we have share capital which will be paid in the list G. Then we have debentures will be paid in list D. Bank overdraft. Let's see if it is secured. If it is not secured, unsecured. If it is secured, then list B. Then creditors, nothing mentioned, list E unsecured. Let's see if there is any secured part of it. Yeah, correct. Then following assets are valued as under machinery, leasehold properties, investment, stock and debtors. Fantastic. They've given the realizable values. These are book values. The difference between these book values and these realizable values will go to our deficiency statement. Got it? Bank overdraft is secured by deposit of title deeds of leasehold properties. Bank overdraft is a secured asset. Sorry, bank overdraft is a secured liability. And the asset that's pledged is leasehold property. Now, this leasehold property is asset specifically pledged. And bank overdraft, whatever is here, 54,000 is a secured creditor. So, if nothing mentioned, rest everything is ANSP and rest everything is unsecured creditors. There are preferential creditors of 3,000 which are not included in creditors of 60. So this creditors of 60, no, this creditors of 60 doesn't include some creditors which are 3,000 rupees. These are preferential creditors. So total creditors is 63. This creditors of 60 is unsecured creditors. 3,000 will write preferential creditors. But that 3,000 what will write as preferential creditors? Against that book value is 0. So entire 3,000 will go to deficiency because we are paying off a liability of 3,000 whose book value is 0. Got it, guys? Fine. What else do we have after that? Prepare a statement of affairs. Okay, cool. So let's start with the solution. To start with, machinery is ANSP, leasehold properties is ASP. So in my list A, what will I write? I'll write machinery 1 lakh 190,000 is its book value. So whatever I'll write now, I am not solving the question in detail because it will take a little while to finish it. So we're doing it in a very quick manner here on YouTube, isn't it? So let's do it super quick. So machinery account, I'm going to mark it yellow. So book value is 90,000. Then we have leasehold properties 1 lakh 20. This leasehold properties of 1 lakh 20 is its book value and leasehold properties is asset specifically placed. So I'll not write in list A, I'll write it in list B. List B which talks about asset specifically placed I'll write leasehold property and book value of it is 1,20,000. Then we have the third item, stock whose book value is 3,000. Let me mark stock is asset not specifically placed. So I'll write stock asset not specifically placed 3,000. I'll write estimated realizable values later. I'm reading the question in the order. I can do little bit of question from here and little bit of question from here. But when I do little bit from here, little bit from there, we might not be able to cover the entire question. We might miss out on some details in the question. So let us do the question in the order and not jump here and there through. Got it, guys? Okay, so we wrote stock 3,000, stock 3,000 done. Then we have debtors 1,50,000. This is again asset not specifically placed. So let me write here debtors 1,50,000 asset not specifically placed. Then we have investments. These are also asset not specifically placed 18,000. So let me write this investments 18,000 assets not specifically placed. Then we have cash in hand 3,000. This is also asset not specifically placed. Cash in hand 3,000. So by this we're done with assets. This profit and loss account debit balance 1,20,000 would straight away go to our list H because this is an item having debit balance which cannot be sold. So book value is 1,20,000. Asset is profit and loss account debit balance. Estimated raisable value is 0. So when there is an asset of 1,20,000 which realizes 0 rupees, entire 1,20,000 will lead to loss. So I'll write this 1,20,000 in list H. So come on, let's go to list H. In our list H, surplus or deficiency. To start with, I'll write P&L account debit balance 1,20,000. This is leading to deficiency. So I'll write minus 1,20,000. Got it, everyone? Then we have share capital of 24,000 equity shares or rupees 10 each, that is 2,40,000. 2,40,000 is the book value which I would write in my list G. Correct? List G. Amount that's supposed to be paid to equity shareholders is 2,40,000. It's 2,40,000. Got it, everyone? Then what do we have? We have debentures secured by floating charge 1,50,000. So if these were debentures with a specific charge, they would have come in list B. Because these debentures are in floating charge, there is no secured charge given to these debenture holders. They have a charge on all the assets of the organization. Where do we write these debentures? We will write these debentures now in our list D, that is debenture holders. Shall I write it there? 1,50,000 in my list D. List D 1,50,000. Got it? We'll write the estimated payment amount later. That we are not worried about right now. Bank overdraft is 54,000. Bank overdraft is secured against leasehold properties. So bank overdraft is a secured creditor. Because it is a secured creditor, we will write this bank overdraft of 54,000 in our list B. If not, we would have written this bank overdraft in list E, unsecured creditor. Got it? So chalo, let's write 54,000. Here in list B, we have book value of asset specifically placed. Later when we read, we'll write estimated reasonable value. Now we'll write my secured liability. Secured liability is 54,000. That is bank overdraft. That needs to be paid from the realized value of secured creditor. From the realized value of a specifically pledged asset. If there is amount still remaining, it would come as surplus. If there is amount not remaining, it would come as deficiency. Not deficiency, shortage. That would become unsecured creditor in list E. Great. Then we have lastly creditors 60,000. These are unsecured creditors. So we'll write them in list E. In my list E, I would write unsecured creditors 60,000 rupees. I will write the payment value later. Done. So we're done with that first table. I've only written the first table details. Going further down, the following assets are valued as under. Machinery 1,80,000. Machinery is ANSP. Leasehold properties is ASP. Investment, stock and debtors are assets not specifically placed. So they've given these values. Let's go on posting. Machinery will realize 1,80,000. So let me write in assets not specifically pledged. So we have 1,80,000. Now have a look. Machinery's book value is 90,000, but it realizes 1,80,000. So an asset with book value of 90 is now sold for 1,80,000. So our realization is more. We have realized 90,000 rupees extra. That 90,000 extra what we have realized will become our profit, or it will become surplus, excess money that's available to pay shareholders. This let's post to our list H deficiency. A lot of them don't do it now. They go on writing and later they follow some format. So I'll say no, follow double entry. See, book value is 90. You sold it for 1,80,000. So you made 90 profit. That 90 profit should go to list H. Come on, let's go to list H. So in our list H, I will write surplus on machinery 90,000. Surplus on machinery 90,000 rupees. Got it, everyone? Okay. Then we have leasehold properties realizing 2,18,000. This will come in list B, secured creditors. Have a look at list B, which where we were talking about assets specifically pledged. Leasehold properties book value is 1,20,000. Against that, estimated residual value is 2,80,000. So an asset of book value 1,20,000 is now disposed for 2,18,000. We have sold it for a price 98,000 more than its book value. 1,20,000 is book value, 2,18,000 is realizable value. We've sold for 98,000 extra. That 98,000 extra money that we receive will give us more money in hand to pay our shareholders. So this will go on to for surplus for us. This I would have to write it in my list H again. How much? 98. How would I get it? 2,18,000 minus 1,20,000. So here I would write surplus on no. What did we sell? Yeah, excess of a realizable value over leasehold properties. 98,000. Got it, everyone? Cool, guys. What do we have after that? Then we sell investments 12,000. When we sell investments to the extent of 12,000, we would have to write it in list A, asset not specifically placed. Come here, list A, investments. What value did you sell them at? 12,000. Now, what was the value of investments? 18,000. 18,000 book value of investments, you have sold it for 12,000. An investment of book value 18,000 is now sold for 12,000. So it is now sold for a value 6,000 lesser than its book value. This would lead to lesser money in hand to pay shareholders. So that would be nothing but deficiency. So all the surplus items we're adding, this deficiency item 12,000, let's deduct. So I'll write minus 12,000, loss on sale of investments. Where? In my list H. 18,000 minus 12,000. See here, deficiency on investments. Yeah, loss on sale of investments. How much? 6,000. 6,000. Got it, everyone? Cool. Then what do we have? Stock fetches you 6,000 rupees. Stock fetches you 6,000. If I go to the top of the table for assets not specifically pledged, I'll write stock 6,000. Stock whose book value is 3 is estimated to realize 6. So it is realizing 3,000 more. 6 minus 3, 3. That 3,000 rupees extra that it is realizing will become your profit. Or it will lead to surplus. It will leave you with more money in hand to pay your, what to say, liabilities. So I'll write this 3,000 in our list H. Shall we? Scroll down. Surplus on stock. 3,000. Got it? Then what do we have? Debtors 1,40,000. Debtors are realizing 1,40,000. Debtors we have written them in assets not specifically pledged. So let us go ahead and then write in assets not specifically pledged. Debtors fetching us 1,40,000 rupees. So 1,50,000 was the book value, but it's realizing 1,40,000. So 1,50,000 book value is realizing only 1,40,000. So there is amount forgone. Only lesser amount is being recognized now. So that 10,000 what you don't realize is loss. It would lead to deficiency. So we'll write it in list H. Shall we? So let's scroll down to list H. And in our list H, let's write deficiency on debtors. How much? 10,000 rupees. Minus 10,000 because it's leading to deficiency. So we're done with this table also. Let's go down to the last part. Bank overdraft is secured by deposit of title deeds of leasehold property. We've already considered this. There were preferential creditors, but let's close this part. What will we do is, let's go to list B. In the list B, see 1,20,000 is the book value and estimated residual value is 2,18,000. So 2,18,000 may say secured liability is only 54. So in 2,18,000 realization, if you pay 54,000, we're still left with surplus of 1,64,000 rupees. This 1,64,000 will be used to pay other liabilities. If in case secured liability was greater than the estimated residual value of asset, then we would have written in unsecured liability column here in list B, and it would be also posted to our list E unsecured creditors. Got it? So let us now write this 1,64,000 in our summary of cash available to pay liabilities. So in our summary of amount available, we'll be first writing, I would say, realization from assets not specifically pledged. We'll write it little later because we have not completed that part yet. Let me write surplus of ASP, that is 1,64,000. Got it? So then what do we have? There are preferential creditors to the extent of 3,000 which are not included in 60,000. So creditors in the balance sheet at book value is 60,000. There is preferential creditors of 3,000 which is beyond this. So whenever there is preferential creditors with beyond the normal creditors in balance sheet, it means that against this preferential creditors of 3,000, book value is 0. So book value 0, amount payable 3,000. Book value 0, amount payable 3,000. Now you see what's happening here. When a book value is 0 and amount payable is 3,000, we are paying 3,000 extra, which would lead to creation of deficiency. So I would write this 3,000 in my deficiency and also write it in our list C, preferential creditors payment. Chalo, come here. In my preferential creditors, I would write book value is 0 against this preferential creditors, which is 3,000. This is paid. So our amount available to pay the other liabilities and shareholders will reduce. And that reason, I'll write this 3,000 in my list H. In my list H as unrecorded preferential creditors 3,000. Got it, everyone? Great. What do we have after that? And that's it. Nothing else. Entire question is done. Let's just close our format now. So if we come to list A, we have the realization from all the assets except cash. Cash cannot be sold. What cash we have is the cash realized. Hey, can you ever say, okay, I have 3,000 rupees cash, I want to sell, who wants to buy and at what value? Huh? Is that possible? Definitely no, I guess. So I'll write 3,000 rupees as cash in hand. Got done? So now the total of the cash available by realization from assets not specifically placed is 3,41,000. Now to this I'll add over 1,64,000. 1,64,000. That's arising by surplus from ASP. So totally we'll have 5,05,000. In this 5,05,000, we pay off our preferential creditors 3,000. When I pay it, I'll be left with 5,02,000. Then I'll pay my 1,50,000 debentures. So if I pay 1,50,000 debentures, I'm left with 3,52,000. So after list D comes list E. I'll pay unsecured creditors to the extent of 60. There is no other amount given. So we're paying them at book value. Then I'm left with 2,92,000 rupees. From that 2,92,000, I'll pay preferential creditors who are not there. So no payment. So 2,92,000 is the amount available to pay equity shareholders. Let us now see how much is payable. Amount payable to equity shareholders 2,40,000. But what we have is 2,92,000. So we're paying them excess 52,000. There is profit on realization, like we say in partnership accounts. So we have 52,000 extra. This 52,000 what is paid beyond what is payable to our equity shareholders is surplus. This surplus what we have computed in list G should match with the surplus that we have in list H. Let's see what do we have in list H. In list H we have minus 1,20,000 plus 90 plus 3 minus 10. Everything together comes to 52, which matches with the surplus that we've arrived at in list G. So list G surplus 52 matches with the surplus in list H 52,000. There you go. You have it. That's how we basically do a problem on statement of affairs. I have now explained to you as to how to do statement of affairs in liquidation chapter. This brings an end to our part 1 to our discussion. In the kind of questions that I told will come about in this topic, the first part is preparation of statement of affairs. We're done with the first part of this. There is another question on the same topic which you guys can consider doing. This question is again in ICI material. So what we did right now is illustration number 12. You have illustration number 13 which deals with the same thing, very similar thing with little difference in values. Insol Limited, and I would want you to take up this question as homework and then have a look at this. If you have any doubts to this question number 13, you can always get in touch with me. Drop a message as a comment to this video, or you can get in touch with me on my what to say personal messaging app on or say an academy where you can drop in a message or on official Telegram channel, and I would get back to you with your what to say with the solution to the doubt that you people are texting me. And that's with regard to this video on liquidation of companies. We'll see you soon in part 3 of liquidation of companies. In the part 3, we will be starting with next part, that is liquidators final statement of account. I'll discuss how exactly do we go about the topic of liquidators final statement of account, and we'll also see a couple of problems on this part. So see you in the next one. I hope you enjoyed and then liked this part of the video wherein we discuss the entire liquidation in bits and pieces. We'll be continuing to do the remaining part in the upcoming videos. So remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something new or having fun, it's all good. The day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question for all of you people. Are we in the game? I hope your answer is yes, we are in the game. See you in the next one. Till then, tata, bye bye. Take care.